Hello and welcome to our November edition of Amundi's Market Review. 4 topics have been in the spotlight over the past month: Chinese economic slowdown, energy crisis, central bank statement, and the corporate reporting season in the United States. Let's start with China. Despite the relaxation of social distancing rules, a confluence of factors continues to weigh on the economic recovery, including the housing slowdown, decarbonization cuts, and the energy use control. Services consumption and infrastructure investments are likely to bounce back, cancelling out part of this slowdown, but we expect China's GDP to grow 7.7% and 4.7% in 2021 and 2022 respectively, down from 8.3% and 4.9% a month ago. The economic recovery is in the shadow of the political agenda. Fiscal policy is reluctant to turn back accommodative, while the central bank continues to inject ample liquidity. We expect the Chinese slowdown to have spillover effects via trade and commodity exports. While we struggle to see positive trigger in a 6-month horizon, we maintain a constructive long-term view, as we believe these adjustments in the policies and in the economy aim at addressing a more sustainable and balanced growth in the future. Moving on to the topic of energy crisis. Over the past few weeks, natural gas has hit the headlines because of a surge in pricing, which is contributing to an inflation in global resources. The energy sector is suffering from a demand-production imbalance in Asia, namely China, and Europe. In China, seasonal factors and weather conditions in spring and summer, such as the struggles with coal production and a reduction in hydropower caused by low rainfalls, put further pressure on natural gas. Europe is facing winter with low inventories, which raises concerns of a potentially insufficient supply for the coming month. Despite Putin's announcement, it's going to be very difficult for Russia to boost natural gas flows in the near term, as current levels are already higher than pre-COVID ones. However, we think that despite the rally, natural gas prices are not out of control, and we expect the world to be in net surplus in the end. Natural gas flows should rebalance imports in Europe and Asia. Moving to oil, we think pressures will persist, but we do not anticipate a power crunch this winter, as we expect the organization of the petroleum exporting countries, OPEC, to gradually increase production. Moving on to the monetary policy and central banks. Central banks remain vigilant and keen to manage the twist between inflation that continues to rise and growth that, while remaining above trend, continues to decelerate. More asynchrony is underway, and all eyes are on the forthcoming meetings. The European Central Bank will announce its decisions in December. Let's now move on to the corporate earnings reporting season in the United States. So far, the reporting season is robust. We are not seeing evidence of margins compression yet, as we feared, and forward guidance is overall constructive. Having said that, there is a sense of uncertainty regarding growth perspective when moving into 2022. How did markets react to all these news flows? Financial markets showed a two-faceted dynamic: rising rates and slowing equity markets in the first half of October, and the other way around as soon as the corporate earnings reporting season started in the second half of the month, reassuring somehow market participants. Equity markets approached the end of the month on new record highs, with the exception of the Japanese Topix Index. The risk sentiment remains constructive, but could weaken easily if investors lose confidence in the ability of policymakers to contain inflation while nurturing the economic rebound. Conversely, we witnessed a bond rally in the second half of October. Rates are erasing the initial lifts and are landing on almost unchanged levels. On the currency front, the British pound and the Japanese yen moved almost 2% down versus the US dollar respectively, as a result of UK budget shifts and worries on the Japanese economy. Oil prices moved higher with 10% gains. Let's wrap up with our investment conclusions. We stay neutral on equity and search for possible entry points at better levels, being aware of the risk ahead. We confirm the overall short duration stance, but we do not expect much of a rise in rates for now. We continue to favor credit as fundamentals have been improving, but at current spread levels, selection is vital to prepare for the next sequence when liquidity risks will rise. Thank you for listening. Please keep safe and see you next month for another market review.
TMB และธนาชาติเปลี่ยนเป็น TTB เปลี่ยนเพื่อให้ชีวิตคุณดีขึ้น